Are you interested in investing in apartment buildings but don't know how to do it? In this video, I'm going to show you 4 ways you can invest in apartment buildings. And make sure you subscribe right now so you don't miss more videos about building wealth with multifamily real estate. And if you don't know me, I'm Seth Ferguson, an 11-year real estate veteran, real estate TV show host, real estate investing podcast host, and the author of the real estate book, Sell for More. But before we get started on the 4 ways to invest in apartment buildings, I think it's important to highlight why we want to invest in multifamily real estate in the first place. And I have 5 reasons why. Reason number 1 is stability. CBRE, the big commercial brokerage, just released a study that looked at all the different types of real estate assets, commercial real estate assets, and how they performed during the past 2 recessions. And they found that multifamily real estate outperformed all the other asset types. So that's like industrial, retail, office space, etc. And they actually found that, that the rents were a lot more stable in the downturn, values were a lot more stable, and also multifamily real estate started recovering a lot sooner than the other types of assets. So if I'm looking for a place to put my money, stability is number 1. I want to preserve my capital. I don't want to lose money. And this is why banks and other lenders love lending and giving mortgages on multifamily real estate. Number 2 is strong cash flow. And just to go back to recessionary times, not wishing it upon anybody, but at some point it does happen, strong cash flow is so important because where people get in trouble, especially in 2008, 9, 10, people without strong cash flow got into a lot of trouble because they couldn't meet their debt service. But multifamily real estate is incredibly strong for cash flow. We have economies of scale. If you're looking at buying a single family home or a fourplex, look at your management costs. You're going to be paying 10 to 12%. With 100 units and plus in a multifamily deal, that cost, that economy of scale brings that cost down. Also, the more units you have more units under one roof or roof, depending on which side of the country you're on. All these things come into play to decrease expenses and improve your net operating income or NOI. Number 3 is tax benefits. This is done through what's called depreciation. So the government gives us credits because the government feels that over 39 years, the value of our real estate building will go to 0. But we know as smart investors that real estate is an appreciating asset. And then we also front load this with a cost segregation. So on day 1, we can get a very sizable paper loss that really reduces our tax liability, if not wipes it out completely. So lots of tax advantages that come along with owning multifamily real estate. Number 4 is scalability. So this goes back to when I first started investing in real estate. I started buying single family homes, and I realized that I would have to own 1,000 houses to hit my real estate investing goal. Can you imagine owning 1,000 houses? That's just plain crazy. But can you imagine owning 1,000 units? Yes, you can, because all the systems are in place. The scale helps you out. You're able to have professional management. Scale becomes so much easier once you start playing in the larger multifamily space. So you're able to scale a lot quicker. And this is the number one reason why I switched gears and started investing in multifamily real estate. And number 5 is you control the valuation. If you have a single family home, you have to bank on all the other homes on your street selling for a certain price in order for you to get that one price. It's called the comparable approach because we're always comparing. In multifamily real estate and commercial real estate, we have a lot more control over the valuation of our property because this is valued on the income approach. NOI drives the value along with the market cap rate. So actually I have a video on the income approach, and I'll put a link up here and you can go check it out if you're interested in learning how to value these large commercial properties. So these are 5 really strong reasons why we want to invest in apartment buildings. So now you're asking, well, this sounds great. I really want to invest in apartment buildings. What are the 4 ways to do it? So the first way you can invest in apartment buildings is buy the property yourself. Now, this this presents a number of challenges. Challenge number one would be capital. Let's say you're buying a $15 million, 150 unit property somewhere. You're going to need about $5 to $7 million, depending on what you're doing with it. Unless you have $5 to $7 million lying around, you're not able to take it down yourself because you have to start raising capital. Also, you need experience in a team. Sellers care about whether or not you're actually going to close on the deal. There's lots of times deals get put under contract, then the buyer doesn't close. They want you to close. So you need a track record, experience, and a strong team. If you don't have that, nobody wants to sell to you. And then also you need the time, because you need to build relationships with brokers so you can get deal flow. You have to find the deals, underwrite it. If you're busy in a full-time career being an expert at what you're doing, you don't have the time to take down a deal yourself. Plus you have to learn the different markets. This is a really full-time job. And actually, if you're interested in learning about the top 7 key market drivers I look at when analyzing a real estate market, go to topmarketdrivers.com. I have a free report that takes you through how the top 7 key market drivers really impact a real estate market. So that's a free download for you right there. So method number one, buying it yourself. I don't recommend it. There are a lot better ways to invest in apartment buildings than taking down a deal yourself. Okay, so method number 2 is called a partnership. Now, a partnership, you'll find this in smaller deals. Let's say 50 units up to 100 units. This is quite common. I know one investor who still does a partnership for some larger units, but typically once you get into the bigger ones, we'll be looking at points number 3 and 4 I'll be talking about. But partnerships are really great. Sometimes you can have a number of partners, sometimes it's 2. And I always draw the pie example here. So let's say I have one partner who has the capital, so somebody with $5 million. I don't have the capital, but I have the real estate experience. Well, we can form a partnership because capital needs somebody to steer it and put it to work, but also the person who wants to put capital to work needs the capital. So in that case, you might have a 50-50 split down the middle. Now, the thing to remember with partnerships is that both partners are considered to be active. There are no safety measures put in place to protect the partner bringing the money, so the money partner. You can also have partnerships for people. Let's say you have 2 people bringing the capital and 2 people, maybe this person has property management experience, and this person may have deal flow. They might have the relationships with the brokers. They know how to manage the construction, etc. So this could be a 4-person partnership, and everybody could get, let's say, 25% of the pie. Now, obviously, this is all up for negotiation based on what each party is bringing to the table. I'm just showing you a very simple example. But keep in mind, there are no protections afforded to somebody bringing capital to a partnership because you are considered to be an active player in that investment. So partnerships, like I said, these work really well for some smaller properties, but once you get into the bigger ones, there are a lot better structures to use. And structure number 3 would be a syndication. Now, a syndication, this is more of an advanced structure, but there are a lot of benefits to this. And in the syndication, we have 2 parts. We have what's called a limited partner, or limited partners in the plural. So these are the investors with capital. So you could have doctors, lawyers, accountants, programmers, you name it. These investors have the capital, but they don't have the time, the knowledge, experience, because they're busy being an expert surgeon. They're busy in court, winning court cases. They're doing what they do best, but they know that all the advantages, like we talked about, the 5 reasons why we actually want to invest in multifamily, they know that stuff, but they don't have the experience or the time or the team around them to actually do deals themselves. So what a syndication is actually a pool of resources. So all these investors will pool their money together, and somebody called a general partner, this is the person with the real estate experience. They will take down a deal. So let's say it's a 150 unit property, and the limited partners will invest their money into the deal. Syndication, lots of benefits with this. The limited partners, well, they're limited, so if something does go wrong, as long as you're working with a very strong general partner with a great track record, the chances of that are quite low. But if something does go wrong, the limited partners aren't considered experts in the deal. They're just providing capital. So there's a lot of safety mechanisms in place in terms of the legislation. So they are really afforded a safety net in that structure. Also, the general partner, they're able to focus on what they do best, which is making real estate assets perform. We have a full-time team managing properties, sourcing deals, making relationships with brokers and sellers. These people are full-time in the real estate business. And like myself, I've been in real estate for 11 years now. And this is what we do best. We source deals, we build relationships. We know when to sell, we know when to buy, we know what sort of value add strategies to put into place, because this is our full-time job. And in a syndication structure, we have a split. So the investors, I'll just use a general example. So the limited investors could get 70% of the profits, and the general partner could get 30%. And there's also typically what's called a preferred return, which makes sure that the limited partners participate in the profits, so they get paid first before the general partners can participate. So this is talking about alignment of interest. The great thing with the syndication as an investor, you get a lot more control, because once the general partner has a deal under contract, they'll start raising money from the investors. So they will present, so if I'm the general partner, I will present to you the deal, tell you what I like about it, where it is, what value add strategy I see, the time horizon for the investment, and you can decide whether or not, based on that specific deal, whether or not you'd like to invest. And this brings us to number 4, which is a fund structure. A fund structure is very similar to a syndication structure, but there's one key difference. So number 4, we have our fund. So just like a syndication, we have our accredited investors here, or non-accredited, depending on the type of offering. So they are pooling their funds. We have doctors, lawyers, accountants, programmers. They've pooled their funds. And same thing, we have the limited partners here, then we have the general partner with the real estate experience. But remember, with the syndication, the general partner would bring a specific deal to the investor, how I talked to you about that. Well, in the fund structure, the investors invest not in a specific property, but they invest in a fund. So this is the fund here. The fund will have investment criteria, which is how the investors will choose whether or not they want to invest in the fund. But then the fund itself will go out and acquire multiple real estate properties based on the fund's criteria and the general partner's expertise and knowledge. So in this case, the investors don't really have control over which property they invest in. That's all up to the general partners, but they are investing in the fund criteria and the plan and the business plan for that fund. The fund does have a lot of advantages because it has a longer life cycle. Typically, you're investing in multiple properties in one fund. You don't have to be vetting deals all the time, and this fund will grow so sometimes the fund will sell a property, then will acquire another property, and funds can have a much longer lifespan. To learn how you can invest in the deals I'm working on right now, go to callseth.com to set up a quick initial phone call. And if you like this video, smash the like button, leave a comment, and let me know what you thought. And until next time, happy investing.